right, so Joe back. Joe, I can see you. Well, I saw you on here.
Now you can hear me?
Now I can hear you.
Okay.
Lori's here.
Let me just try and get myself set up. Okay.
Lori, I have unmuted you.
I'm here.
Yep.
Okay, let me just fix my screen a little bit.
Okay.
Are you guys ready for me?
Yeah.
Absolutely.
Okay. Welcome back, Lori.
Thank you.
I know you don't need any introduction, but Lori's been with us doing the once a month financial reporting and financial health. She's graciously agreed to join us now with a whole hour of Zoom. And Lori, any particular subject today, or just again your general?
I actually do have something prepared. I'm just hoping if I click this box. Do I have screen share?
Steve will.
We should. There you go.
Let me see now. I got to get you guys off the screen. Well, I'm not showing exactly. I don't know how to get that off the screen. 1 second. Let me just see if I can get that.
I think you grab that bar in the middle of the screen between the two screens and pull it to your right.
Well, I'm trying to, I was trying to get the picture to be the whole screen, but that's not wanting to do it, but that's good enough. Can you see that picture?
Yeah, the graph.
Yeah.
Graph, yeah.
Okay, good. So I just did a webinar kind of on a market update, and there were some pretty interesting statistics. I thought I would give you guys some really current information and some food for thought, if that's good to start. Okay, so you probably have all heard this, but from February 28th to March 27th, the S&P was down 34%. It was the fastest fastest and largest monthly decline in history since they've been keeping records, right? Everybody here, everybody knew that? Oh, I guess everyone's muted, never mind. From March 28th till the last couple of days, in 2 months, we had a 40% gain off of a low bottom, remember? And the question is less bad equal to good? Because there's nothing good about our economy, but from March 27th forward, it got less bad. So net year to date, the S&P is only down about 7%. And I have to say that's shocking to me and probably to most of you. But when you dissect it, what you're looking at on the screen is that Apple, Amazon, Facebook, Google, and Microsoft represents 20% of that S&P index that we see every day when they report the indices. So 20% of the 500 stocks are those 5 stocks. And the because the S&P 500 is a market weight index. So the larger the stock, the more weight it has in the returns. Oh, sorry, skipped it. I didn't get it. I was trying to take pictures of the screen so that I could share them. I don't have the document. The other 495 stocks were actually down 8%. The top 5 were up 15. So when you think about that, this was not a broad rally. And the interesting thing is the last time that we saw the kinds of valuations that we have now in the S&P, where the top 5 stocks represented 20%, only 2 of them were technology stocks. And today, they're all technology stocks. And I think the theme here is that there's been a tremendous shift from the year 2000 to now in the way that our country runs, the way that our companies create value, and the way that we're going forward. So in other words, if you just held industrial stocks and you held your Honeywells and GEs and even IBM, I guess I would consider as kind of a stodgy older stock, you have way underperformed anybody who had a technology fund, almost any technology fund. You could throw a dart at the board and have outperformed the old stodgy stocks with the new technologies. And I think that is a permanent trend going forward. So that was something that we were discussing on the call. It was kind of interesting. Let me see if I got the economic dashboard. Yeah. So this is a really, let's see if I can make that. Does that look bigger to you now?
Yeah.
Okay. So
Yep.
So Merit is the firm that I merged into earlier this year because I wanted to have more size matters. Here's another theme, is that size matters. Small companies can't keep up with the compliance requirements, the need for capital, the shift you can see just in these PPP loans. The big get everything first, the big get economies of scale, the big get better pricing. So I merged into a $3 billion firm. We represent about 10% of that firm now. And what I'm getting is access to a lot more software and detail and capacity. And every month there's the CFA that's on staff does this investment workshop where he goes over a lot of details, and that's where I'm getting these slides from. So they're not to be shared with the public, but I can show them to you. So this is, actually, this is a slide that will come out and I can share it every month. This is their way of representing where the economy is today and where it was over the last 12 months. The lighter the shade of the line, the further back is the date, okay? So what you see, what they highlighted in the current lines is that anything that where the line goes into the pink is a warning, okay? So the way that the chart represents it, it's not what the pure number is, it's the risk that number presents on the chart. So what you're looking at right now, there are basically 4 factors that have changed significantly, and you can see them in gold. So the interesting thing, the TED spread is interest rate risk, okay? And hopefully you're all following me. I'm throwing out some jargon here. The TED spread says, what is the risk to your bond portfolio? Now, a couple of months ago when this all started, there was a major panic in high yield bonds. And most of you, I hope, are nodding your heads that you know that. I'm not looking at your pictures. What that says to me is, what happened when we went from the threat of bankruptcy to pretty much taking all the risk out of the bond market? And what that was is that the Fed stepped in and said, we are going to buy bond ETFs, exchange traded funds of bonds, including high yield bonds. It's unprecedented. It's never happened before again in the history. And the Fed basically backstopped the bankruptcies from happening by buying lower credit quality bonds. So that's one really incredible change. And that's part of the reason why we're not in a depression today. Had the Fed not stepped in, the high yield bond market would have been destroyed. The availability of liquidity to corporations would have dried up. Instead, what we're seeing, and I'll get to that a little bit later, what we're seeing is how much borrowing corporations have been able to do, given nobody knows what earnings are going to be in 6 months. The second thing was the financial stress, which is the risk index. And the financial stress has actually come out of being a problem, again, backstopped by the PPP, by the Fed, and we're hoping, by the CARES Act, and we're hoping by the next liquidity injection that we're going to get from the government. So that's an interesting one, because again, if you asked on March 20th where we would have been, you would have said the financial stress index would have been off the charts and the TED spread would have been off the charts. High yield default risk, again, it went out of being, supercharged problem to being, okay, this is manageable now. And inflation is the other one that's interesting. We, for the first time in a while, are actually seeing a change in the inflation risk. And you probably have heard people talking about that also. When you have so much liquidity injected into the world, it's not just the US, sometimes you'll see prices will rise, right? There's a lot of money chasing things. If there's a lot of money chasing something, the price goes up. Now, why do we not think we're going to see a surge in inflation? This is not what you're seeing on the chart, but this is how do you interpret it? And part of what's happening is there's an expectation right now of the economy springing back, people going back to work, and but they're not spending as much as they have been saving. And somewhere on here, see if I can find that savings rate chart. I'm not sure if I have the savings rate chart, but what we see is that the rate of savings was averaging, well, basically liquidity is not being deployed here. I don't have the savings chart, sorry about that. The rate of savings, I have the notes on it though, jumped to 33%. And if I was in the room, I'd ask what do you think the average savings rate in the United States was 2 years ago? And the answer to that is 5%. So between 5 and 10%, all of a sudden, everybody got those checks from the $1,200 checks and the people who are collecting unemployment, but they're not spending it. 33% from an average of 5 to 10 on the savings rate. And that is actually deflationary, because if the consumers aren't out there spending money, which we expected they would do, we all expected you give them a check for $1,200, they're going to go and spend all the money. But what's actually happened in reality is that they're not spending it, they're saving it, and therefore we actually have more, well, not maybe more, but we have a risk of deflation as well as we have a risk of inflation. No one knows where we're going to be in 6 months. Will the virus go away or will it be back? That's the major uncertainty, the thing that we can't really answer the question. And this is also very interesting. So what do you look for to see if there is actually a recovery? And some of the key things are air travel. And you can see that air travel is just starting to bump up. And if any of you know someone who's flown, a friend of mine took a one-stop trip from Palm Beach to Rochester, New York, and both flights were completely full, much to her dismay. And it was on American Airlines. What we're hearing is that I think it's JetBlue and I'm not sure the other one that are not filling their planes, but American and maybe United, definitely American, say, we'll let you know if your plane is full and you can change your flight, where other airlines are saying we won't fill our planes. Very interesting and something you should look out for if you're going to be flying and you're concerned about having a full plane. But there is a tick up that's happened in air travel. I think it was down 80%, now it's down 60%. So that is a big increase. And they're also increasing the number of flights again slowly. Restaurant bookings. This is an interesting one too. That is pent up demand for people to go out to eat. If you could see that on the chart. I mean, there was obviously nothing from March until the middle of May. And then as they're opening things up, we're seeing a tick up in restaurant bookings. The most interesting is the home purchases. And there are two factors influencing home purchases. One is mortgage interest rates, which are at all-time lows. You can get a 30-year mortgage for, you know, somewhere between, you know, 3% and 3.25%. You can get a 15-year mortgage right now under 3% if you have good credit quality and all the other factors. And I think that's really, really interesting. If you live in Fairfield County, what you've noticed is they're now having bidding wars on houses. And this is really incredible. I mean, there was no demand because there were no showings and nobody was going anywhere. Now people want to get out of the city. They want to have space. They don't want to be cooped up again if this happens again, whenever the next pandemic is. And we're actually seeing a resurgence in more suburban than urban areas. So that's another very interesting factor. This is another chart I really liked. So Chase reports their consumer spending by categories on their cards. So here you can see that in March, everybody went to the supermarket. My friend said he took his daughter and they had 2 carts and they stocked up. They had canned goods and toilet paper and Lysol and you know the story, because if you went a week later, none of that stuff was on the shelves. And the difference again is restaurants completely fell off the table, except for takeout. This is healthcare and pharmacies. Spending went down. People weren't going to the doctor, even if they needed to, or the doctors, dentists, you know, any personal services were being canceled. Other retail, again, dropped way down and only started to pick up in the middle of May when they started reopening the stores. But what you do see also is that this is discount stores and wholesale clubs are still below where they were March 1st. Restaurants are still way below 50% off where they were. And we're just now starting to see a little bit of a recovery in the other retail and a leveling off now of what people spend at Costco and discount stores and supermarkets. Okay, the big surge has happened. The other trend is that more money as a percentage of spending when you're not there. And what they're saying, when you're not there, that's because you're buying it on the internet or you're buying it over the phone and giving somebody your credit card, like a restaurant order. And the drop when you are there in person, this is the blue line, March 16th, card spending positive as a percentage of total spending, dropped off the table and is just again now starting as people are starting to physically go back. But internet spending, when you're not present, has gone way up. And that tells you that people are trending toward a comfort level with internet spending and things like PayPal and Venmo and using card services over using cash and signing for your purchases. And that's why companies like PayPal have had significant increase and Square increases in their stock prices, very significant increases. Let's see here. I'm looking at my notes for a minute. So this is just showing that the velocity of money, this is the turnover of money. Again, we know that people just aren't spending and they're not earning, and we're just not seeing a turnover in the numbers. This is maybe one of the most interesting of all charts. This is showing all the countries and negative bond yields. And everyone but the US on this chart has a negative 6-month rate of return. In other words, you go, you buy a government bond, you buy an Ireland government bond, and you're paying them 35 basis points, 0.35%. In France, you're paying them 0.5% to hold your money. It's just incredible to me. And part of what that's doing is it's bringing money into the US where you can get positive returns. That you have to worry about hedging your currency, but you can get positive returns. And as you look out further on this chart, here's Germany. Okay, Germany has negative bond yields all the way up to their 30-year bond, which is just barely even positive. I just find that is absolutely incredible, unbelievable. Here's the, in Italy also, they have to, you know, Italy, nobody's willing to pay Italy to take their money right now. The Italian banks are probably some of the riskiest. I just don't understand, again, that people would even consider, number one, trusting the Italian government, but number two, all of this other part of the chart where everyone has the negative bond yields. It's just, you know, again, 10 years ago, could you have even fathomed that this chart could look like this? It's really astounding to me. This one shows, oh, this is, I talked about this before, corporations are borrowing money. In 5 months, they've borrowed what it would normally be borrowed in a full year. It's pretty incredible. Once the Fed came in and backstopped, what this basically says, the record pace of borrowing reflects businesses and investors are comforted by the Federal Reserve backstops. S&P Global said this week the number of potential debt downgrades is at an all-time high. Credit erosion into 2021 is likely. They're jumping in and getting as much borrowing as they can before their debt gets downgraded, because we don't know where the economy is going to be. So a lot of corporations have stocked up on cash. And this is the chart that shows you what the Fed is doing. This, see if I can make this a little bigger. Can you all still see that? I don't know if anyone can talk. Okay,
They're all muted.
It's blurry.
Okay.
It's blurry.
It's blurry.
Yeah.
Better or worse?
Blurry, but smaller. It's worse for me.
All right, well, I will do a little bit of reading on this for you. The top most, this is just in the first week that the Fed stepped in and bought ETFs, okay? These are bond exchange traded funds. The first one is LQD, which many of you may own. That's just investment grade corporates. $2.5 billion, sorry, that's shares, $325 million worth of US investment grade corporate bonds. The second one is intermediate term corporates, not necessarily all top investment grade. That does, I'm not familiar with these Vanguard ETFs. $216 million of the Vanguard short-term corporate bond, VCSH, which some of you may be familiar with. That's just basically really, really short-term. It's kind of a parking place for your money instead of a money market. But the most interesting one is the fourth one, which is $100 million worth of HYG, which is the high yield corporate bond ETF. JNK, which stands for junk, 83 million. And then they bought some more corporate short-term stuff, intermediate corporates, investment grade US dollar-based corporates. Here's another high yield fund, ANGL, 11 million. And this is just in a week. And then some more short-term corporate and short-term investment grade and short-term high yield on here. So it's just mind-boggling. It's $1.1 billion that they spent, and they spread it around, but a lot of high yield bond purchases in there. And the ETFs go out and they take the money that you put to them and they buy the individual bonds for the shareholders for the most part. So that's really, again, never happened before, unprecedented. Had the Fed not done it, we would probably be looking at a deep recession or even potentially a depression. I mean, that was an absolute necessity, and thank goodness they did it. This is a chart showing you the valuations of the US market versus the developed international markets. Now, in the era you guys might remember in the Nifty 50, before we had the terrible 73, 74 drop in the stock market, this is relative to international. The Nifty 50, the top 50 in the S&P 500 were significantly overvalued compared to international developed markets. The internet bubble, 99 and 2000, we capped out here, not as bad as the Nifty 50, but the valuation metrics, and I'm not a big proponent of international stocks right now, because really you would have said here that, or maybe where the Nifty 50 was, that international would outperform domestic. But I think it's because of the negative interest rates and the economies over there being somewhat in a shamble, and Brexit and everything else that's happening, people are still willing to pay up to have US equities. And that's what this chart's telling you. But the valuations are getting a little bit frothy. My most favorite little 5% position that I've picked up personally is the emerging markets. And the emerging markets are expected, can you see that? Expected to recover sooner. And, you know, maybe when you go down more, it's easier to recover more. But the emerging market economies are in a very unique position that they've never had wired phone systems, for example. Everyone just jumped right into a cell phone. Their cell phone is a smartphone, and it's the first computer they ever had. And it's their first exposure to the internet. And there's still 1 billion people, for example, in India who don't have cell phones yet. I don't know what the number is in China, but these are massive amounts of economies where all of the technologies that we're talking about, they're just skipping over having an industrial revolution in those countries. They're going right into being much more advanced in their technologies than we are. Their infrastructure is being built for the 2000s, where we're sitting on old infrastructure. So I think it's really interesting. I think it's for people who have a little bit of a stomach for potential volatility, that the emerging markets are very exciting right now. There's one investment that I love that buys internet-based companies in the emerging markets. Their biggest holdings are, like Alibaba and Baidu, and the companies that are the Amazon and the Facebook of the developing world, where Amazon and Facebook haven't been able to get in, and Baidu and Alibaba, and there are a couple of other companies that have dominated their markets. So if you're looking for an interesting opportunity, I would say look for something with emerging markets in it. The only other thing that came out of their investment meeting was that they are concerned about the valuations in the US market, and overall just stock valuations. So they are, this is the investment team. I do my own investing, but I always listen to what they say. In August of 2019, they sold, and they rebalanced. When they say they sold equities, that just means they went back to if they were supposed to be 60% and it went up to 65, they went back to 60. So they would sell equities and buy bonds or fixed income or cash. In February, they were very smart, and they rebalanced again because they thought that the increase here, again, took the equity versus bond allocation out of whack. They rebalanced again here, where they actually bought equities. And today they announced that they're going to rebalance again and cut back on equities and increase bonds and cash. So nobody wants to be a market timer. This is not timing, this is rebalancing. But I want to point out to everybody that it's something you should be looking at in your own risk tolerance, that you should be thinking right now, looking at all these charts, looking at the valuations. Maybe you want to, if your equities have moved up, if you've been in those 5 stocks, maybe it's time to reposition a portion, not all of it, but take, you know, if you've got a big gain in your Amazon or your Facebook, or some of your semiconductor stocks or some of your healthcare stocks, that it might be time to pare back, not to sell. One last thing I didn't mention is that in 2017, in the United States, there was about roughly $2.5 billion in money markets. And again, if I was in the room, I'd say, what do you think the dollar amount in money markets is today? And I'll give you a chance to, I wish I could do a survey here and I would survey you, probably could do it, and ask you to think about that number, which today is now $4.5 trillion. So money market funds in 2 years have increased by 2 trillion. And that's another aspect that's been pushing the stock market up. It's the FOMO market. It's the fear of missing out. And people who cashed out at the bottom down here and were sitting on cash and could never get back in are now the last ones coming back in again at these higher valuations. And some valuations are out of the universe. I mean, the valuation on Zoom stock and Peloton and some of these companies that have been, you know, the stay-at-home stocks. Well, now that we're reopening, the question is, can they maintain those valuations? Zoom had absolutely blowout, unbelievable earnings. And I don't have the numbers in front of me, but if you look it up and see what they reported, I think it was yesterday, they reported their earnings, and it was just absolutely incredible. Zoom has now become a word like to Google. You Zoom, you Kleenex. And in such a short period of time, Zoom has become part of the fabric of our society worldwide. It's not just here. Everyone is using Zoom. You're having Zoom weddings. You're having these kinds of conference calls. You're having one-on-one Zoom meetings we do with our clients. People are doing Zoom coffee in the morning, Zoom happy hours at night, monthly family get-togethers. They're seeing their family more than they've ever seen them before. It's a phenomenon that's absolutely incredible. I think it's just a matter of time before Microsoft and Cisco figure out a way to take market share. I don't know if they'll do it by price or by giveaways, but to try to take some market share away from Zoom because they already have products. They just didn't have a good catchy name or market it or make it as simple to use as Zoom did. But again, I don't know how long that can last. I'm not running in to buy Zoom stock. Let's see if there's anything else here. The only other thing that, that they pointed out is that because the Fed is buying these bonds, it's created a false sense of security in the markets. And the biggest worry we all have is if Congress doesn't approve money for the states. So they think about this, they approved money for corporations so that corporations wouldn't lay everyone off, and they increased unemployment benefits, et cetera. The states are the next shoe to drop. And the question is, why are they hesitating? Because if the states can't balance their budgets, they're going to be laying off massive amounts of not only the state employees, the people that run the unemployment programs, the people that, you know, the police department, the fire department, the emergency, all of the municipalities, all the states and cities are suffering from the expense of the COVID, yet for some reason, McConnell does not want to bail them out. And you may have heard Jerome Powell, in the sense he was imploring them to do it in his last testimony. That to me is the critical factor that has to happen. If they don't come in and have another package to help out the states and cities, then everything that you just saw on these charts is going to be for naught, because that's going to be a major, major problem. We're already seeing, what if we didn't have the number of police we have now in all those cities where they're having so much, you know, civil discord? So that's my political statement for the day on that. I will open it up to questions.
Okay, for anybody wanting to ask a question, use the blue, raise your hand, and we'll call on you.
Larry?
Larry. Unmute yourself, Larry.
With regard to the air travel, is there any indication as to what the percentages are on business travel versus leisure travel? You know, where you see the tick up. And then
I haven't,
a follow-up question.
I have not seen that. I mean, there may be statistics. I haven't seen them.
Yeah, and the longer term, I think there's going to be less and less business travel as the teleconferencing and Zooming for business meetings occur.
I agree. And I also think if I was an owner of office buildings or a REIT of office buildings, I'd be in a tremendous panic right now.
Okay.
People are not going back. We did a survey within, our firm has, this bigger firm I'm part of now has 16 offices, and only one office had all the employees saying they wanted to go back and work at the office. Every other office said, well, we'll come in 2 days a week, or we can share an office now. We're downsizing our space. It's really, it's a trend that had started already. You know, people that can work remotely. I'm working from Florida. I don't miss a beat. I talk to my clients and not missing a beat. And I'll be back in Connecticut in a couple of weeks. But that trend started and it's just accelerated it, you know, probably by 5 years.
Mm-hmm. And a second point related to that as well, as the housing for private homes, for people moving from apartments. I wholeheartedly agree with you, because more and more people are also going to be working from home, and they would, you know, like the idea of more space.
They want home offices. But if I know my friends in, so Emily, who works for me, some of you may have met Emily, she put a bid in on a house in Wilton that had just come on the market. And by the time her realtor called the other realtor, they had already sold the house. First day it was on the market. And she ended up buying a house in Easton because the prices jumped in Wilton. Wilton, she didn't want Weston, Westport, Wilton, you know, people are moving out from the city and they're looking for the towns that are along the train line. So when they want to go to the city, they hop on the train. So those are the towns. Stamford, I'm sure, is having a similar, you know, rebound in their housing prices. I don't know if anyone here is a realtor, want to chime in.
Do you think those housing increases affect condominiums as well as houses?
Most likely, it depends on the size of the condo, I guess. If you're in a 1-bedroom or a studio, I don't know how attractive that would be. But, you know, again, if it's a nice condo with amenities, probably. But, you know, I'm not an expert on that. I'm only telling you what I've heard from my clients and my friends, that the housing market has absolutely turned around in Fairfield County.
John
Lori,
Sedlak, raise your hand, and I'm calling on people as their hands were raised. John Sedlak.
Yes, Laurie, could you comment on gold? There's all kinds of recommendations. Go into it, get out of it. So can you comment?
Okay, so again, I sound like I know all this stuff. I don't profess to be an expert in everything. I own about a 3% position in my big portfolio, not all of my investments, but in my main investment portfolio, I have a 3% position in gold. I own an ETF that owns the physical gold, not the gold miners, not GLD. I own one that's called BAR, B-A-R, and they own the physical gold. That's not a recommendation. You go out and do your own research. A lot of people are recommending the gold mining stocks. I'm just sitting on that. I'm not buying more. I'm not selling it. It's just there. And you maybe have heard a lot of, or seen portfolio construction from different companies where you'll see a little slice of gold in their portfolios. It's not meant to be traded. It's just meant to be held. And just, it's your buffer for the worst case scenario. Did I answer that question?
Yes, thank you.
Alan Krim. Unmute yourself. Alan?
Alan, you're mute. Alan, you're mute. He's keeping talking.
Stu, hold on. Alan, are you there?
There you go. It was a challenge to unmute. Sorry. Just wanted to follow up. I thought, Laurie, that you had made reference to the airline industry operating, maybe going up from 40% to 60%.
No, the other way around. That's how much the change in their decline was. They were down 80% in bookings. They went to down 60%.
Wow. Even that notion seems to me to be underrepresented. They are, so much of the fleet is sitting down on the tarmac. And many of the planes are operating at 20% load factor. My impression would be, versus the number of passengers a year ago, I'd be really surprised if it was 20% or 25% that high of what they had been carrying. That's one observation. Another, of course.
That's a statistic. You're probably looking backward at the month of May and not forward at June and July. People are booking flights.
Well, I guess I'll try to monitor that a little bit and see where things really are. It's rather surprising. The other interesting dynamic about the industry, of course, is that it's looking forward to the fall. They are going to be laying off loads of employees once the government support ends. So the industry is really, really challenged, and it's likely to take 2 or 3 years before it approaches where it had been, and that might be an optimistic projection.
Well, that's the unknown. Is there going to be a vaccine, and when?
Oh yeah, it's you're right. I mean,
but I think you'd be surprised. I do think you'd be surprised if you notice, if you go on CNBC and search for Phil LeBeau, Lebeau, I think he spells it. He's the reporter on the airlines, and he's got the statistics from the airlines themselves. They're adding routes. They're adding the capacity. Again, my friend flew 2 flights, and who goes to Rochester, New York from Palm Beach? And both flights were full. Disturbing that they were full. And this was about a week ago. So I know my friends that go to Spain every year, they just booked their flights for August 31st to go to Spain. So I think what you're seeing is people they think they're going to get refundable tickets. So they're going ahead and booking them, right? Some of the airlines will say, if you book it in June and you cancel before the end of June, we'll give you your money back. So you're seeing an increase in bookings. But again, if they're not worried about getting sick, or if they see that there's a vaccine, or there's, people have to wear masks, then people are getting on airplanes.
Larry
I'm
Berger.
taking the auto train as an example. I'm taking the auto train. I was a little concerned about it, but they're sanitizing everything. They're keeping people distance. They're loading the train cars in blocks, so you're not standing all in a big clump waiting for your number to be called. They're separating people out, and you get in your roomette. They bring you the food, and then you get off the train and get your car and go home. So they're accommodating that. In some ways, the airlines are trying to do the same thing. Not all airlines. Apparently, I would not book an American Airlines flight, but it sounds like JetBlue is taking better precautions.
Larry Berger.
Can you hear me?
Yep.
Okay, sticking with the airlines. With the prices that the airlines are now, it's very tempting to jump into some of these stocks. I'm just worried that there might be some bankruptcies somewhere down the line in the airline industry, or some mergers. What do you think about that?
Well, again, I'm not an expert, and I am not buying any airline stocks myself, because again, it's all virus related. And if they come out and say, you know what, we can't have a vaccine for 18 months, those stocks are going to drop again. right? But if they come out and say, we're going to have our first vaccine in November, chances are those stocks will go up. That's just not my, it's not, I don't need to chase the volatility. There's so many other good things to buy that I would stay away from the airlines personally.
Sheldon.
You mentioned that the federal government wasn't giving money to the states. What is your opinion on why they aren't? I have an opinion on why, but.
Well, they have given some money to the states, but, and again, I'm not an expert. I'm only telling you an opinion and what I've heard and read, which is not the same as being, in Congress and being in the room. They've given money to the states and they've restricted it to quote unquote only be used for COVID related expenses. And what the states are saying is, well, because of these COVID related expenses, we're not getting property taxes, or people are defaulting and they're not paying us and they're not buying new cars, and people that worked in New York City that are working from home don't have to pay New York City income tax. It's not because they got sick. It's because of the shutdown, and they're unable to make a direct correlation to the government, and they've already gotten the money that the government allocated to them for the COVID expenses. This is, again, my understanding of where we are. If you could tell me why Mitch McConnell doesn't want to do the other bailout, then you know more than I do, because I think that the Congress, the Senate is where it's being held up. The House has passed it. The Senate is held up.
I know why, but I don't know why. I think they're trying to get better control over this. The federal government's trying to get better control over the states.
But if the states can't pay their workers and have to lay them off, and you don't have enough police and you don't have all those services, nobody to run the unemployment offices, they're all state-based. Medicaid is all state-based. It's a conundrum for sure.
I had one other comment about the airlines going from Palm Beach to Rochester. There's a lot of I'm in Florida right now, near Palm Beach, and there's a lot of Canadians trying to get out of the country back into Canada, and they'll go any way they possibly can.
Okay, I didn't think about that one. Where are you? What city are you in?
Palm Beach Gardens.
Oh, so am I. What community?
East Point.
So am I. What city?
Sand Crane Drive.
I'm on Oak Knoll.
Oh, we got to get together.
You have a golf cart?
I will this afternoon.
Yeah, we do golf cart happy hours.
Where? Hello?
Wherever, in somebody's yard. We all drive our golf carts up and we stay socially distanced and we have our happy hours.
Oh, that's great. Wonderful.
Laurie?
Yeah.
Yes, can I? Hello, can you hear me?
Yes.
Yes, you point out, en passant, I would say, the question of the state difficulties to raise money from tax sale or real estates, all kinds of things. I think somebody asked why the Senate doesn't approve, because those states that will be more affected are, in one way, democratic states, because they have a more problem. And therefore, there is a political reason on the Senate's problem not to have too much money going there. And the second question that I think, or first, same times, probably is the time to review pay structure of these people work from home. How do you calculate a fair salary? Somebody will home, how will be deductible for tax? It's open a completely a new dimension on salary structure, salary remuneration, and the relationship between place of work, a place where you pay your tax. So I think that debate, we don't know where it's going, and until probably the election day on November will not be solved. What do you think?
Well, if you listen to Governor Cuomo And I'd be interesting, I mean, we could sort of see raise of hands. We did it last time I was on, we did something where we could see everybody answering a question, but Governor Cuomo made a statement and said that New York pays a surplus to the government based on the income taxes. Kentucky has a negative 5%. Where New York is paying in, Kentucky is taking out. They're taking out more than they're putting in. New York is putting in more than it gets back, right? Do all of you know about that?
Yes.
Yes.
Okay. If you answered, click the on the participant screen. There's a yes or no. So, and I think, Lori, that would go for Connecticut.
Yeah.
That also goes for Connecticut, not only New York State.
Right. Well, it's
We've
been
heard-
the blue states. In general, it's California. All the blue states are paying in more and all the red states are taking out more. And here's the question though. Now, New York is going to experience a significant drop from the people who worked in the city and live in New Jersey and Connecticut and have been working from home, right? The city and the state are going to suffer a very significant drop in taxes. It should benefit Connecticut and New Jersey, but New York is the one that's had, you know, probably the most impact from the virus. Not to say that that Connecticut and New Jersey got away scot-free. But then you have people like me and John who are in Florida and are not going to pay any tax to the states. We're not in the states. We're not working in those states. And this winter, a lot of people stayed out of those Northeast blue states and stayed in Florida and Texas and Tennessee and other places. And so all of those states are going to lose revenues. And I don't know how they're ever going to make it up. On top of that, with the unemployment, people are getting property tax relief. They're not paying their property taxes. You know, they want to either they get food, they pay their mortgage, but they'll default on their property taxes. So there's a you know, multiple whammy against municipal governments getting revenues. And the federal government, if they bail out the airlines, why are they not bailing out the states, right? Because the airlines, the people who own the stock, the stockholders should be taking the risk of the airline going bankrupt. But everyone suffers when the municipalities can't pay the police officers and the emergency people.
Well, I think, Lori, I think what it is what Mitch McConnell has said. He said that it's purely political. He's saying that these large states and large cities are too generous in their social benefits, and we're not going to bail you out because you're spending more money than you should on your people.
Well, isn't it destiny? If you offer the benefits, they will come. I mean, have any of you been to Santa Monica, California? They probably have the highest percentage of homeless people because they've got a humongous, and if you know this, you know, raise your hand or say yes, but if you've been to Santa Monica and you know about this Salvation Army building, let me see a new poll here. Not too many. If you've walked in Santa Monica in the morning, the amount of homeless people where that, you know, where the Ferris wheel is at the pier, you always see the picture of the Santa Monica pier. It's not safe for me to walk there in the morning because of the number of homeless people. And why are they there? Because of the weather and because there's a Salvation Army building. They get food, they get a place to shower, they maybe get a place to sleep. The weather is great. So in New York City, think of the homeless population there. If you offer the benefits, they will come. But how do you stop offering the benefits once you've offered them? So, you know, again, this is an opinion. My opinion is that we are in this situation now and we have to look at it realistically. You know, are we human beings? Are we helping? I mean, all these protests that are going on are because people are feeling there's no equality here. They'll never get out of the hole they're in. And this is only making it worse.
John Bullock, you had your hand raised a while. John?
Can you hear me?
Yeah.
Yeah.
Okay. I can confirm the Stanford real estate market is crazy. Patrice and I are presently renting and our lease is up at the end of July. And over the past week, we've tried to see 4 places. One we were able to get into and we weren't interested in, but I hear it went for a price over asking. Another one we went to see and the realtor met us at the door and said, I'm sorry it's sold, it's already got backup bids on it. And 2 others were gone before we could even get a sitting. So I'm sitting here saying, maybe I should renew my lease for another year. And I would assume that maybe the real estate might calm down and hopefully interest rates might stay the same or even go lower. What do you think of that, Lori? I know you can only tell me what you sense. And
Right. My sense is that interest rates are going to be plus or minus 1/4 to 0.5% of where they are now in the next 12 months. I don't think we're going to see a huge jump, but I don't think mortgage rates are going to go a lot lower than they are now, because there has to be some kind of a spread, you know, for the banks or the lenders to make something on those mortgages, or why should they, you know, they have to staff, they have overhead, they have costs. So
I'm hoping on the price side that real estate stabilizes and this bidding war calms down to more of the same situation.
I do think that will happen. And I think you're running into the peak of the season right now where people who want to get out of the city and have kids want to move during the summer. So best time, you know, maybe you could do a 3 or a 6 month renewal. The best time to buy is probably in November or December, when, you know, you don't have competition from people with children trying to get into Stamford.
Got it. Great.
Bill Layden.
I'm going to check that out with my landlord. I don't know if he'll go for a 3 or 6 month, but because I'm sure he says, you know, it's easier to rent a house in the summer than the winter.
Well, see if your lease allows you to go month to month at the end of your term.
All right, thank you.
Okay.
Right. Bill Layden.
Can you hear me?
Yep.
Oh, good. Yeah, I just wanted to comment when Lori was talking about what happens when the states run out of money. And she mentioned, for example, not having the police. But the amount of money that the government spend on police is a relatively small part of their budget. Most of it is the social welfare stuff. I mean, if states like, you know, New York and Connecticut could cut back on their very generous social welfare costs, they could save a lot of money. So
well, it's hard to know that, because when you're looking at what we have going on in this last week is the civil unrest, right? We're seeing people that are lighting businesses on fire in the downtowns of these cities. And how do you know that taking away the people who are already poor and homeless, and now you're going to say, well, we're not going to give you food stamps, or we're not going to, you know, provide any health care for you, that's not going to create even worse civil unrest now that they're seeing that something's happening. I think the timing is really bad to try to do that, because by doing this, all of a sudden, the whole world now, even London, all over the world, they're saying now Black Lives Matter, right? This all happened in a matter of 9 or 10 days. And the entire world is having protests in all these cities, and we're having chaos. Now, the chaos may not be by the original protesters, but we know that there's some insurgents going on where people are going in there, and it's not the peaceful protesters are not the ones that are looting and lighting fires. But my opinion is that by taking those meager benefits away from those who have nothing, you're just throwing fuel on the fire.
Is it? That sounds like the agenda of a certain whatever faction it is, because look at the 2 lawyers that were pretty evidently successful lawyers that firebombed a police car.
Well, I don't know about that one.
Oh, a Yale lawyer, the Yale educated lawyer, and a girl who is a civil rights lawyer, firebombed with Molotov cocktails a police car in New York City.
And they were clearing out.
If you did a demographic analysis, I don't think either the protesters or the rioters are desperately poor people, you know, who have just been driven to it because they can't put food on the table. They're basically you know, people with very liberal bent who just, this gives them an excuse to express their views.
This is Steve. I can't raise my hand because I'm a host. But one of the other aspects that we're talking about, we touched a little bit before about the government unions. And there's state of Connecticut, city of Stamford, a lot of other states and municipalities have large unfunded pension plans. And I think that's part of what, whether they're right or wrong, I think that's part of what the Senate is looking at and saying, you want us to bail you out, and you've got all these people there with stuff that you agreed to when you never thought about how you were going to pay for it.
But we've talked about that a lot. I agree with you. They're underfunded, not unfunded. But with meager returns on fixed income in the last 10 years, the money that was projected to be there, obviously they underperformed the investment returns that were projected originally. But I think that the pensions need to be renegotiated in the states and cities. I absolutely 100% agree, and I've mentioned this numerous times.
And that may be what they're trying to force.
But this is not the time that they can make that happen. In my opinion, we've got 25% unemployment, and it's not the time to do it. That unemployment is, I mean, do you want to have bread lines again? You know, we're just facing a really unprecedented time in our economy. And would you want to make things better or worse? Because I think that would make it worse. First, you got to get it better and heal, right? Before you take the Band-Aid off, it's got to heal. In my opinion, again.
Yeah.
Les G. Les. Les, unmute yourself.
Okay, that better?
Yep.
Okay, yeah, I just wanted to say I'm a realtor in Stamford with Keller Williams, and over the past month, there's been a tremendous upsurge from people living in New York, from people living in high rises in Stamford. They want out. They want to live in a single family house. We've had an awful lot of multiple bids, houses going for more than asking, particularly if they're in fairly decent shape, and at the entry level range, which in Stamford is like $700,000 or less. This is also extended into the Norwalk area. How long it's going to last, I don't know, but it's not just me. Almost all of my colleagues in real estate are extremely busy trying to convince people if they do want to move, they have to act very quickly when the realtor calls and says, hey, I want you to look at something. Because tomorrow it probably won't be there.
What are the interest rates that you're getting in Stamford?
We're getting, on a 30-year, you're getting 3% to 3.25%. And as you said earlier, under 15-year or 10-year, you can probably get 3% or less.
Okay, thank you. Joe Raccanello.
Yeah, hi, Laurie. I know in your presentation you mentioned the emerging markets and the international stocks. I was kind of curious, a lot of your clients, do you find that they really want to stay out of those areas, the internationals and the emerging markets, or do you find that a lot of your clients like some diversification as well, and that, people have made money in emerging markets and international stocks before? Do you find that the clients, they like the diversification, or they feel it's too risky at this point in time?
Well, my clients mostly ask me, don't tell me, they just ask me. So that's different people than, I would say that we have exposure to international through multinationals. You've heard that jargon before, I'm sure.
Yeah.
Very few Apple, look how much business they do in China. All the major technology companies and semiconductors and pharmaceuticals, the industrials, they're all doing business all around the world. The real question for me is the stability of having, the stability and the reporting that you get meeting the standards where you're actually knowing what's going on with the companies who aren't headquartered in the United States. the emerging market internet, let me see if I can put something up on that. This is my favorite little, let me see if I have something.
While Lori is checking, when we finish the meeting, I want everybody just to stay online. I have a question that I want to get some response to.
Yeah, I don't see it.
I'll do that. This is Steve. For all the board members, just remember the invitation that I sent out to you for the board meeting is different than this meeting. So you can't use the link for this meeting.
Right.
No, I don't think I have it open. And I'm not sure if I can do it. Let's see. Oh, I see. It's on a different tab. You're not seeing, are you seeing a picture?
No.
Are you seeing Zoom?
Nope.
All
We're
right.
not seeing your desktop.
Okay. There we go. No, I don't have it on here. I'm not sure if I can do it while we're live.
What symbol?
EMQQ. If you can put it up, Joe, maybe.
No.
Did you lose me again now?
No, we've got you.
Oh, you got me? All right.
No, I mean, we have you.
Do you see my screen?
No,
No.
we just see you.
Just see you.
Okay.
While you're doing that, another question. We talked about real estate. One of the things that I've heard is happening in Stanford, whether you can believe it or not, is there are people from New York looking for office space in Stanford because of two factors. One, that they are larger, they can get the space cheaper, and now with social distancing in the offices, they need larger spaces there before they were consolidating people. And number two, people don't want to have to wait for elevators going up to the 33rd floor being crowded, where you've got lower buildings here and you don't have to wait as long, even if you social distance on the elevators.
And another factor is that people are afraid of the trend of offices or little cubbies, not even cubby holes, just desks and a workstation within 24 inches of the next person. So the trend might be where they need to keep people in the office to go to, more of a cubicle or open area, giving them more space.
And yet another factor is would favor opening more office space in the Stanford area is avoiding the commute in on Metro North. Lots of people don't want to do that.
Well, number of reasons. Okay. Lori, did you come up with any?
I just brought up EMQQ. Is that what you were looking for?
It's on now.
Lori?
You're muted, Lori.
Lori, you're muted. Lori, you have yourself muted. Could you unmute yourself?
Yeah, I can't. I got off of that. Let's see.
Or it's frozen.
Looks like she's frozen.
Yeah. And Dick, you were just going to ask you a question.
You think she had to jump off because it was noon?
Yeah. I don't know if it's that late.
Okay. Well, while we're waiting,
Right, she's coming back on. I have to unmute.
How about that?
Now,
Okay,
where are you?
I don't know. I got a phone call and it knocked me out of my thing. All right, let's see if I can.
I can bring up, you wanted the EMQQ?
Yeah, I'm just getting a delay right now.
I've got it on my screen, I think, if I bring it up.
I'm trying to start my video. Something's going on with my computer.
Right.
Too many things open, I guess.
Is that what you wanted?
There you go. Can you see that?
Yes.
Okay, so that's EMQQ. And now, who's running this, Steve?
Yeah.
Okay. So if you go into, but you don't have the advanced version that I have, so you can't see all the stuff. But if you scroll down, maybe you have positions. Just wanted to show the top 10 positions. This is the emerging markets, internet and commerce. So rather than owning the broad emerging markets, just like if you remember that the top 5 S&P stocks were all technology, and that we have a trend, an absolute changing trend in the world.
Is that what you were looking for?
Yeah, so that's, yes, you scroll a little, here's your top, it says top 10, I only see 5, but.
Oh, this is, yeah, I don't know.
Okay, so Mercado Libre, and I had a little piece on this that told me on each of those, each of those names, you know, one's the Facebook, one's the Amazon, one is the, because Mercado Libre is like the leading company in South America. Here, let me see. It's Argentina, MELI, Mercado Libre, if you see the top 10 holdings. Argentina, Brazil, it's Amazon and PayPal combined. They're also providing commercial banking. So the first one on that list, their top holding, Mercado Libre, I don't know if you even ever heard of it, almost 8% of the total assets, but that's because it's had a year-to-date return of 49%. You asked me to start my video?
Yeah, okay, if you want to do that, I'll stop sharing.
No, let's stay with what you have, because
Okay.
I'm afraid I'll get knocked out again. So Alibaba and Tencent together are basically everything that we get in this country with Amazon and PayPal and music services and streaming and Netflix, all of that. JD is also in the kind of Amazon space. I don't know, NetEase wasn't in the top 5 when I did it, but the other 5 that are in the top 10 include Yandex, which is the Google of Russia. And they're also doing Uber. And MMYT is the Expedia of India. And JMIA is the #1 commerce company in Nigeria and expecting to be in all of Africa. So when you look at the emerging markets and you look at the Amazon, Facebook, PayPal, you know, Netflix, Apple, streaming Apple, not Apple hardware, and you look at what that is in our country, and then you look at the adoption rate that's still waiting to happen in the emerging markets, it's an absolute, to me, my opinion, this is a no-brainer, but everyone, this is not a recommendation, do your own homework. It's just, to me, the internet, it's just an absolute home run to own those companies. So if you don't own any of them now, if you don't own Alibaba or JD, you might just buy this kind of a fund or any of the emerging market technology funds, and there are a few others out there that will give you exposure to a broad selection of these companies that are, the growth is astounding. We think Zoom had amazing growth. Wait till, you know, the Zoom of these emerging countries is going to happen soon. The problem is they don't all have internet yet. So as they get a smartphone with internet, they buy, most of their shopping is done online, especially having this crisis where they're all getting locked down. I mean, Alibaba had unbelievable numbers in China because they're e-commerce. Baidu is another one. So again, I'm just pointing out that I think the US market's overvalued, and this has had a great run year to date. If you can click on the performance tab. And you should all do your homework. You go in and you search for internet, emerging market internet companies or tech companies. So if you go back to 2016, 10,000 has turned into at least, 16,000? And we're nearing the peak that we had at the top of the market right now. This thing is going to blow, I think it's going to blow out.
Right, last question, Dick Fisher.
Okay, yeah, I'm on. I was just going to point out in Lori's question about why McConnell is taking the position he is, Trump was in a podcast interview with a conservative commentator. He said he is in no rush to provide federal assistance to states that are short of money because of the coronavirus. And he said Democrats would have to make substantial concessions if they want grants for state governments. So there's your answer on McConnell.
So we're going to have to wait until December, after the election, when people vote with their feet, vote with their pocketbooks. I don't know. I'm politically, I'm not saying, red, blue, or in between. Personally, I'm more in between, but you just can't recover from a depression if you let that happen. And I think that you can't have your states and cities going bankrupt. I mean, just fathom that. That's, it's not a political question, it's a humanity question. If you can save the airlines, you should be able to save the states, right? How about a vote on that? If they're willing to vote, if they're willing to save do you think they should have saved the airlines? Should they have saved the cruise? I mean, all of these companies that are getting money, should they be getting money? They have shareholders.
Not getting any votes.
Nobody's getting.
Also have employees, and it's not the government to provide employment for people. It's private companies that provide employment.
But the government employs your police, your municipal, Medicare, Medicaid, all those government services.
That's true. That's true. But
and do we want law and order?
They have the security.
Or your garbage pickup.
They have the security
Right.
of being government employees.
Okay, I think we're going to have to end this now. It's 10 after 12. Lori, would you like to sum up?
I would like to say one thing. Maybe we can get that, click on participants and give me a show. I am doing a, let's call it a series of either coffee or lunch or wine and women and wisdom for the women that you care about to have a similar Zoom to this for women only, in a forum where I can give them some basic financial background and let them ask questions. And I'm doing it for my clients, and we have a group of, actually a group of therapists who are going to share it with their clients. And the question is, do you want me to give you guys the Zoom link, and the women in your lives, your wives, your daughters, your granddaughters, your sisters and nieces and nephews, nieces, not nephews, but share the link? Is there an interest? Is there an interest in that?
Let me just speak for the group. I think, if you will send that information to Steve, Steve can certainly send an email to all the members, and we can pass it on to our wives or significant others with the link. I think that would be the best
That's what
way.
right.
Yeah,
I just
that's
wanted
not a
to-
problem.
When you get it, you'll know what it is. You'll know that that's what we're doing. It's going to be more of a town hall, this kind of a format, maybe less of a technical presentation and more of a personal finance, gentle presentation. And then we'll have open forum for questions.
Yeah, I think doing it that way, therefore, you know, whoever wants to invite their significant others and families, they can do it. They'll know at this point of what it is. And that would be a great idea.
Okay.
Okay, with that, the question I had, I'm going to clear the table there, and just the question referring to what we wanted to discuss at the board meeting, without knowing, you know, specifics. Do all our members feel like they would want to have some form of meeting in July and August on Zoom? If you do, please, you know, vote yes or no. Okay.
I say yes.
I'd say based on the trending, there are 24 yeses, 6 noes, and 15 abstentions.
Joe DiBartolo keeps raising his hand. Joe, you have to unmute yourself.
Okay. All right, it looks like that's enough information. We'll just stop the voting now for us to discuss at our board meeting in 45 minutes. So thank you, guys. Thank you all for participating today, and thank you, Lori, for very informative discussion and presentation on the economy as it stands with the pandemic and what the thoughts are. So with that, guys, stay well, stay safe, and stay healthy. And we'll see you next week. Thank you.